So when I was tasked with designing today's discussion, I thought, well, deal structuring, that could mean a lot of things. So I thought that given that we have a lot of students in the audience, it might make sense to focus on some of the fundamentals, how a real estate deal comes together, the different components, and a typical life cycle. Not only do we have quite the illustrious and accomplished panelists today, but they all represent different players in the real estate industry. One is a privately held real estate company, one is a public company, and one is an investment manager, who actually, all by the way, very recently transitioned into new roles as well. So their combined breadth of experience should give us really diverse and great insight. So with that, I think I'll turn it over to each of you if you could just introduce yourself and a little bit about the company and how you got there and your experience.
Great, I can start us off. I'm Sarah Hawkins, and I run the Hines East region. So I'm based in New York, but cover New York, Boston, DC, Philadelphia, and everything in between. And as FARAH mentioned, I recently transitioned into this role. So I was previously the COO of the East, and before that, worked leading a development project. So I've been with Hines for 10 years. We're a privately held real estate company. So most of you probably know us as a large-scale office developer. We also have a big portfolio of multifamily, industrial, and we actually do both acquisitions and industrial. And then we're vertically integrated. So we have a development and acquisition team. We also have property management, operations, engineering. We do facilities management, so kind of up and down the real estate services. Over to you.
I'm Sarah Queen. I run MetLife's real estate equities group. And so for MetLife, we have both money that we manage for our own internal account. We also have separate account clients that tend to be pension funds, sovereign wealth. We have funds as well. I recently joined MetLife 6 months ago, and coming out of college, was there almost 5 years, ended up in the real estate group, loved it. That began my real estate career, then left and went to business school, spent time at Clarion, Brookfield, and Mapletree, and then was recruited out of Mapletree to come back to Met. So it's been full circle for me.
That's great. Hilary?
Hi, everybody. I'd like to thank Darcy for inviting me to be here today. I'm super happy to be back. I think I spoke about 5 years ago, and so this is my victory lap, I guess, from the last one. I joined Boston Properties 4 weeks ago, so if you have any challenging questions about Boston Properties and its mandate, I have a great team of ladies from Boston Properties over in the corner that will be happy to talk to you in detail about it. I am the Executive Vice President and the incoming head of the New York region for Boston Properties. Prior to joining the firm, I was at CPP Investments, which is the Canada Pension Plan. I ran the Americas for CPP, which included teams in Toronto, New York, and São Paulo in Brazil, and sat on their Global Investment Committee. And prior to that, I was at JP Morgan for 15 years doing real estate acquisitions, primarily in New York City. So it's been super exciting to me to be able to come back home to New York in recent weeks and to join an operating platform like Boston Properties. So as FARAH mentioned, Boston Properties is a public company. It's the largest publicly held owner of office buildings in the country. We are also developers of life science assets, and we have a multifamily vertical as well. And I think my mandate as I go forward is just to help the team sort of build its platform in New York and expand its mandate here. And I'm super excited to be here. And just as an aside, when it comes to sort of the discussion about maintaining relationships in the real estate industry and how rewarding that can be, Sarah Queen introduced me to my husband. So, and I now have a son. So like Sarah's responsible for all the good things in my life.
I love that not only do you have personal relationships, but you've all worked together as well. Go women.
Well, this is definitely not as meaningful as what Hilary just said, but I just want to add, it is such an honor to be on stage with the two of you. And true, like we were talking in our kind of pre-panel about things coming full circle, and I just remember vividly when I started at Hines, I think it was 9 or 10 years ago, Hilary, who was running Northeast acquisitions for JP Morgan, touring one of our developments, and I just remember thinking, that is a total badass lady. Like you had that haircut,
and then we did the deal together, right?
We did the deal together. It was
Park.
awesome.
Yeah,
and then Sarah is, are you technically the head, or you're just the head of the real estate committee
Yep.
of Trinity, who's one of our largest partners, most important relationships, working with them on their assets downtown. So it really does all come, it's
Full
a small
circle.
world.
It's
in
a
the-
very small world.
In the real estate world, it's so important.
Great.
So it's really important to, particularly for those of you who are students, to continue to nurture those relationships you
Peer
have now. Yeah,
relationships,
Absolutely.
Because it's so much fun when you get to interact with people that you really like and get to do deals with them. It's so much more fun.
That's very true. So speaking of doing deals, what's the first step, Sarah? Does someone call you or do you make a call? How are you sourcing new deals? Especially in this very competitive market we're
Yes,
in.
well, it's, I mean, I guess the easy answer is it's, all kinds of different ways. So if I look back on where we've actually been successful, though, deals that we've actually executed, because we look at a lot of marketed deals, but the deals we've actually executed, the vast majority, I mean, I don't know the exact number, 90% come from existing relationships. So it's something that, may or may not have been off market. There have been marketed processes where we get involved, but we have some sort of edge because there's an existing relationship or there's something that we can bring to the table that others can't. Or it's phone calls from owners, from sellers who we know, and there's a path to a deal more easily when there's existing relationships.
And that's definitely true. But I think there's a lot of deals that are being widely marketed, and you have to pick and choose where do you want to really focus your energy.
Well, I was going to say, speaking of picking and choosing, is there sort of a menu, if you will, so to speak, for as a manager of both institutional funds, sovereign wealth funds? Are there types of deals that specific types of investors are really focused on?
Yeah, no, very much so. Like some of our clients have very specific return requirements or additional requirements that they're looking for, and so when certain deals come in, you start thinking about, okay, who would fit this deal? But as we look across, so we have $33 billion under management today, and as we look across the clients that comprise that, we also are trying to think about, okay, how do we induce some of our clients to get a little maybe outside of their comfort zones, particularly as we've seen yields drop. So, if you only want a 7% deal, you're not going to be doing any deals these days. And so how to talk to them about getting them comfortable with where the market is. And then there's a very complicated allocation process for how deals actually get assigned. But we do some internal marketing to our clients to try to get them more active on certain deals.
Sure. And Hilary, can you talk a little bit about the difference or the transition from where you were a CPP and to a public company now, and how if that has an impact on how you're sourcing investments?
The nice thing about moving from CPP Investments to Boston Properties is that their investment strategies are actually really well aligned. They are both investors that have a return requirement that is higher than some people in the market. So, we're always looking to add value in assets that we own, whether it's by redeveloping them or building from the ground up. Or repositioning an existing asset that maybe was underperforming under a previous ownership. And so, I think that in answer to the question about how you source deals, we do look at marketed deals. I think that we try to take a view on where we want to be in the market. And so it's really easy with some marketed deals to say, like, great asset, but we already own a ton in that area. We don't need to own any more there. We're really looking to expand over here. And then, to the extent that a deal is marketed, do you have an angle on it? Or are you just, competing with everybody else with no advantage, in which case, maybe not the best use of your time. So even when the deal is being marketed by somebody capable like Darcy, who's got everybody looking at it, you have to say, like, am I the right buyer for this asset? Am I the one that's going to be able to bring something to the table that will make me successful in this process? And otherwise, building your relationships over time so that you know who owns that piece of land that you're interested in, or who might be needing to sell an asset 3 years from now. Like, keeping those relationships alive, I think, is really important to generating deal flow.
Sure.
And I think also, I would just add that being a good partner, particularly like for somebody like us, we've been partnered with Hines before, and because we were a good partner to them previously, then they call us for other things. But that's across the spectrum, and sometimes we control the deal, and it's being a good partner that way as well.
Sure, that's actually a great segue to the next topic I wanted to cover, which is really capital, right? Both raising capital as well as deploying capital, potentially different structures, equity structures. I know there was a whole finance panel before, so I'm not going to spend too much time on debt capital, but SARA, Hawkins, as a privately held company, how does Hines approach capitalizing its projects?
Sure, so it may be helpful just to kind of break down our structure. So the standard deal for us, we are investing Hines balance sheet capital in most of our developments. And we're typically a 5 to 10% partner, and then we bring in an LP for the rest of the equity. So we are, if it's, there's a range of ways that deals come together. If you take something like One Vanderbilt, which was talked about on the last panel, we're partners there with SL Green, who owned the existing asset that we demoed to build One Vanderbilt. They brought us in very early. We were a development, essentially consultant to them, figuring out what was possible, what was feasible, and working together with them until we created a viable project that then, once it was de-risked, we could go into the capital markets together and bring in equity capital that would give us the best terms once we had fully de-risked the project, taken it through entitlements, gotten all of our construction drawings complete so that we could get a GMP. We had really de-risked it to go out and get the best terms for an LP. So everything from that to going long on a piece of land where we may we're typically not going to go long on a big piece of land where it's 100% us, but we may option it, we may go in with a partner, and it'd be an opportunity where we have really high conviction that we can take it through entitlements, de-risk it ourselves, and then bring in capital. So that's on the development side. On the acquisition front, we work both with direct capital sources on a one-off basis, and then we also have our own funds. So we recently closed a Core Plus fund, so we're out in the market looking at opportunities to buy across product types, to buy assets.
That's great. Sarah Queen, what factors typically dictate how much equity you're going to invest on behalf of your clients versus maybe leveraging with debt?
So we have some clients and some mandates that look for no leverage. So there you go. That's one point. And then we have other mandates from clients who are comfortable going to 65% leverage and everywhere in between. And so it really depends on the asset itself, and we try to marry what makes the most sense on the asset strategy with the hold period and what's going on in the market. And one of our advantages is we actually have a very large debt business as well. So we get to have the conversations with our colleagues across the hall. We were all in the office together, now on a Zoom call, but kind of talking about what they see going on in the market since they're actively involved, and that can help us make what we think are better decisions for our clients.
That's great. Hilary, what about you?
So I'd say the key differentiator between our capital structure and SARA is that both SARA and SARA work in private businesses, and so they're raising capital through the private markets. Boston Properties, being a publicly held company, has the ability to raise capital in the public markets and in the private markets. And so, depending on the strategy, we may elect to own 100% of the asset ourselves, in which case we would probably raise debt through unsecured financing at the corporate level. Where we have joint ventures and our partners prefer to have asset level debt, we can do that as well. And so we really have a lot of flexibility in terms of how we pull together a capital stack. But at the end of the day, our objective is to put together the optimal capital stack for our shareholders. And so we're not really doing third-party business where we're going out and raising capital to invest on behalf of others. We're doing it for our own account.
That's right.
And then the other thing I would add is that working at CPP Investments previously, there are some sovereign wealth funds and foreign pension funds and domestic pension funds that can literally just back up a truck of cash and buy anything they want, no matter how big it is. And so one example of that would be the 550 Washington, the St. John's Terminal Warehouse building, which Darcy was involved in, and which just priced in the market. I'm sure you guys saw it for $2.1 billion. That was the largest individual asset transaction I did while I was at CPP. And we took that to investment committee with a $1.6 billion development budget on spec. There was no pre-leasing, there was no financing, there was nothing but an idea that would be a spectacular project. And CPP and its operating partner, Oxford Properties, has the kind of capital to just do that. So, it's worth knowing that that kind of capital is out there as well.
And Hillary, since we touched on that a bit, is there a cost of doing business, if you will, to working with foreign investors or sovereign wealth funds that require particular tax structuring in their transactions?
So putting my previous hat on, I would say no, but the reality is that there's tax structuring that you have to accommodate. And I would say that the folks that we all do business with are very, very sophisticated about these things. And they find ways to make it as seamless as possible for us to use their capital, because if not, it's very hard for them to invest money. So I think over the last decade or so, the foreign investors who are very active in the US have become increasingly sophisticated about that. And I don't know what you guys think, but I don't really think it's that much of a hurdle to doing business with them.
For the most part, no, and particularly if they've been active for a while. But if they're newer to the US, there's a lot more hand-holding that has to go on, and sometimes some creative work with them on the structuring. But for those who've been active for a while, they know what structures work. Sometimes from our standpoint, we do a lot of co-investing with some of our clients who are looking for that 51%, because we have our own balance sheet to do that as well. But you certainly can structure around it, and they also understand that there's benefits to even with the tax treatment, there are benefits to investing in the US, whether it's stability, growth markets, or just diversification plays for them. So as long as they're getting a market return, it seems to continue to work.
Yeah, the challenge for us is if an investor will only go up to 49%, because in that case we have to pair them with someone else, and we do it. We've done it all the time, but I'd say that would be the extra step that we would have to take versus an investor that's willing to go up to 90 or 95.
Because Hines is typically keeping the 5 to 10%.
Because we're going to be the 5 to 10% and
developer, right?
Yeah, and that's just to give a little more context on that, we have private capital, so we don't have access to the public markets, and we're investing our own balance sheet, and that is literally the Hines family, 50% Hines family, 50% Hines employees. So we are, our capital is constrained in that regard, and then we also have a very high cost of capital. So we're expecting to bring in a 90% partner to be able to earn a promote on that private capital.
Next sort of component of a life cycle of a real estate investment, asset management. So when is the right time to, or what factors determine when is the right time to recapitalize an asset or refinance the asset or reposition altogether? What factors sort of drive all of those decisions?
So you really have to look at what's going on at the asset itself and what is your projections for the long term. And one of the things that drives me a little nuts, I spend a lot of time in asset management, is people say, oh, it's a core asset. You don't really have to do anything. Well, if you don't do anything, that's not going to be a core asset for very long. There's constant work that has to get done, and you have to, it's constantly seeing activity, and it's thinking through, okay, if I'm not selling it or recapitalizing today, what is the trigger for me to do it? Because you're really saying you would rebuy the asset at the returns that you're projecting if you're not selling it today. So, sometimes if you don't get a lease done, now if you're going to have to release that property, you're holding it for 3 or 4 years. And so, nobody should be surprised by that, but you have to be very active on the asset management side to achieve returns. And I think a lot of people, focus a lot more on the acquisition side, but it is the nuts and bolts of asset management that determines whether you're going to actually achieve your returns.
I completely agree with that. I started out my career in asset management as well, and I learned absolutely everything that can go wrong with an acquisition in asset management. It makes you a much better acquisitions person, by the way. But I picked up a discipline from JP Morgan and moved it over to CPP, which I really liked, which was every year we went through every single asset in detail. What do we think the life cycle of this asset is? Where are we? How are the tenants performing? How is it financed? Do we like our joint venture partner? How are they performing? Fundamentally, do we think this is something that we want to rebuy for the next 12 months, 15 months, 10 years? And if the answer to that is, we're not sure, we think we've maximized returns in this asset, at some place like these pension funds where alpha is the name of the game, it's time to sell it. So I think having that discipline every year to go through the portfolio and say, how's it doing? Like, should we really be holding this? Should, you know, and taking that fresh look is a really, really good discipline in terms of asset management.
I think another thing to add there is what you don't want to do is be in a situation where your capital wrapper is what dictates when you have to sell.
Yeah.
So we've been in that situation many times where we have either a closed-end vehicle or we have a partner where we have a mechanism that's either a for sale or the timing for us to liquidate our position arrives at a time that's not optimal to sell for whatever reason it is. And being forced into that situation is something that everyone wants to avoid. And so we've made a practice where we can, and we're not always successful in it, but aligning with our investors in a long-term hold structure. And actually the last 7 deals we've done in New York have been a long-term hold structure. And by that I mean, instead of targeting a merchant build where we have an IRR-based promote, we actually have a promote based on an equity multiple or a return to capital. So we're completely aligned with the investor. And most of the investors that we're investing alongside have a long-term horizon. They are building, we're building build-to-core assets. We're biased, of course, but irreplaceable assets, trophy, buildings that we're developing, and you don't want to be forced to sell that. You want to hold that until the right time to monetize. So our investors typically want to hold long-term, and we've seen optimal outcomes when we're aligned with the investor to hold long-term as well.
That's great. Since I think we're going to have to cut a little bit short, I have to get to the million-dollar question of the pandemic and how deal-making or doing deals has changed over the last 18 months. And do we think that change is here to stay?
I mean,
I know that's a loaded question.
Google triggered the acquisition of a $2 billion asset, whatever it was, 2 or 3 weeks ago. And, that says to me that the investment markets are alive and well because, I mean, what a commitment to New York, right? We did an acquisition at CPP in Seattle when none of us could get on a plane and go to Seattle, but we already owned assets in the area. We knew the joint venture partner very well. We had great consultants. It was 10 years leased to Amazon Web Services. So, we had a lot of confidence that we could, and JP Morgan was the previous owner, and I know all the people at JP Morgan. So, so we had a lot of confidence that we could execute on this. We kept executing through the pandemic, and I think that people actually want to transact. They want to get back to their lives, and people want to go back to seeing their friends and being in the office and doing all of the things that made them feel good about themselves. So my view is that the pandemic did not fundamentally change the markets. Some things became more competitive. Yeah. Multifamily and logistics became a lot more competitive in the pandemic. Single-family development, single-family homes. But I mean, we're seeing our tenants tell us we are coming back to the office, and that has been evidenced in our portfolio. New York, by the way, leads the country in terms of return to office by a very wide margin. So that's exciting for me.
Great.
So I would say, I mean, there were some real logistics problems, right? Particularly a year ago last summer, right?
Like you said, Hillary, right?
Yeah, you can't go. And I was at Mapletree then, and typically somebody from Singapore had always visited a new acquisition. And so that, of course, was not possible. And we had to figure out how to do a West Coast trip without triggering 2 weeks of quarantining on either side of the deal, which actually was doable, but it didn't feel right. That if you actually were out of the state less than 24 hours and not in their state for 24 hours, you don't have to quarantine, which again, I checked several times, was kosher.
So an international flight there, less than 24 hours?
Yeah, so I took the 6 a.m. flight out, did the property tour, did the market tour, and then took the red eye back.
Wow.
Yeah,
and
it was
exhausting.
gone less than 24 hours. Oh yeah, no, it was. And I kept thinking, this should not work, but anyway, it did. So that made it a little difficult. And then touring office buildings where there was nobody there just felt like you were waiting for the zombies to come from I Am Legend. So that was a little freaky. But, to Hilary's point, people want to transact, and we've seen transactions occurring. And, for the most part, office rents have continued to be paid. And so there's a certainty to that cash flow, which is real. I mean, the underlying lease is what the basis of all the value. So it's been possible to transact, but I think one of the things that we've seen is people who don't have as strong of access to capital have been holding off on making reinvestment decisions in their properties. And so I think as we come out of this, what you're going to see is winners in the sense of people who were able to continue to invest and make the right decisions for their buildings, and those who had to pull back because they had capital constraints are going to fall far, you know what I'm trying to say, fall farther and farther behind. So I think it'll be interesting. And I mean, the last point I'll just make is logistics has been completely on fire, and I think as more and more people.
Pre-pandemic, but really.
It was, but that really ignited.
Yes.
I mean, even my parents are ordering groceries now online, which.
Right.
So I think as more and more people use online, you're just going to continue to see a greater need for that logistics space. Sure. And so as we continue to manage, what does that mean post-pandemic? It'll be very interesting to see.
Any thoughts to add on that, Sarah? Or what we've learned during the pandemic?
Yeah, look, the reality is there's more capital than ever that wants to be in real estate. So there's just a lot of capital going after deals. So you look in multifamily and industrial, it is so competitive right now. Right. I mean, we're constantly trying to find where's our edge, and it's hard on suburban multifamily and finding what the opportunity is there. There's just a ton of capital in that space. There has been less transaction volume in office. I mean, there just have not been as many trades, and I think that's going to start to pick up. I'm maybe a little more circumspect. I mean, I just think there's still a lot of uncertainty. I mean, we are huge believers in the flight to quality. We just saw that play out, and I'll say One Vanderbilt again, where we saw it lease up really through COVID, and so the flight to quality is real. And I just agree 100%, Sarah, on this kind of growing divide between the haves and the have-nots in the office space, where the tenants will have a lot of choices. And so if you're not producing buildings that create an environment where people want to be, where it's convenient and easy, and you have everything there, and you have access to daylight and air and outdoor space, and all the things that tenants, I think even more so today, want, it's going to be harder and harder to compete. So I mean, we're excited about opportunities not only for development, but also for repositioning. I mean, there's just going to be a lot of large-scale repositioning in New York City in particular, looking forward.
As a tenant about to move into One Vanderbilt, we were very excited.
Should be. I'm actually going there after this to take some people through.
That's great. So. I'll be there tomorrow, actually.
Yeah, so, awesome.
Yeah, I hope you're changing shoes. That's what I was on.
I have them in my bag. Yes, please.
Well, in the last minute or so that we have, just quickly, or not, however you want to describe, I'd love to hear about, I'm sure the audience would love to hear about each of your favorite or most memorable deal, whether it was memorable because it was a nightmare or whether it was memorable because you're most proud of it, and why.
I can start. I mean, maybe what I'd like to say first is just our jobs are really fun. I mean, I just feel so fortunate to be in the real estate industry in New York. I mean, we get to go, it's just, there's so many different dynamics and so many different players, and it's so real that you get to walk in it. So when you say that, there's so many things that come to mind, because there's so many things that I've enjoyed over my career. But maybe, I guess the one that comes to mind first is the first development project I worked on, which was 7 Bryant, and we ended up selling it to Bank of China, which is just one of those stories that no one could have predicted. Right. We had a whole leasing program underway, ready to go, and Bank of China basically approached us and said, we want the whole thing and we want to own it. And so we were able to structure a deal. The funny part of that story is we came to a decision on price within 48 hours, and then it took a year to negotiate all of the documents and all the little detail to get
we had to go to Asia to finish it, is my recollection.
Mm-hmm. Which we did with JP Morgan. So it ended up being a phenomenal deal, and just one of those, the projects, development in particular, these are long projects. So there's so many risks, but there are also so many ways to win, and you never can it's not linear, you can never quite predict how it goes.
Sarah?
So I'm going to give two answers. So one of them is I just recently purchased One Memorial Drive in Cambridge.
From JP Morgan?
Yeah, from JP Morgan. And it was one of my first deals since going to Met, and it was a big deal. And so that's always fun, right? It's fun to kind of do a big deal right off the bat. And so that was, and there was a lot of moving parts to that, so that was fun. But to Sarah's point, one of my first asset management assignments, I did a mall redevelopment in Virginia Beach, Virginia, and yeah, I know, and with a pension fund, and secured a $52 million reinvestment in that mall, and had to renegotiate the REA, moved every anchor tenant around, and I think, let's see, I was like 27. I mean, I did not know what I was doing, but I pulled this deal somehow together, and it worked. I mean, it took years off my life, but it was, I learned so much on that deal. It was fantastic.
Hillary?
Yeah, well, I've already talked about St. John's. I'm not going to talk about that again. But so I think one of my favorite deals in New York was the Toy Building, which is 200 Fifth Avenue. It's where Italy is on Madison Square Park. And the way that deal came about was L&L Holdings was redeveloping the asset with money from Lehman Brothers, both debt and equity. And when Lehman Brothers failed, they stopped funding debt and equity for the development of the building. And so L&L, who was perfectly capable of funding their share, suddenly needed, I think it was 90% or 95% of the equity to keep the thing running. And so I wound up negotiating, because L&L wanted to stay in, they had to recuse themselves, and I wound up negotiating with the estate of Lehman Brothers to get the asset out of the bank. And then I recapitalized it with L&L and brought in, I think it was Bank of China, to lend on it. And just to get to watch that deal come together, it was, when I recapitalized it, about a $700 million deal, which was the high water mark by a very wide margin per square foot in Midtown South. But it sort of catalyzed a lot of the redevelopment in that area. And, the building today, is worth meaningfully more than that. So it was really fun to watch all of that come together. It was really complicated. It took about 3 years off of my life. But to see that asset today and how integrated it is into that submarket and how vibrant that submarket is just really fun. That's a really fun
Well, that one turned out better than my mall in Virginia Beach. But I sold it for a good price.
There you go. That's all that matters.
Not
right?
my problem.
Well, thank you all, Hillary, Sarah, and Sarah, for your time and for your wonderful insight. Thank you all for joining us. This was fun.
Thank you very much.
Thank you.
Thank you.